Hey, what's going on, guys? D. Anthony here. I want to give you guys a little example. I want to show you guys something, especially for some of you traders who may be struggling trading futures. A lot of traders that I see like to, dive into the market, as soon as the word go happens, right? It's like you're anticipating, making all of this money as soon as the bell rings. And then what tends to happen is you start chasing candlesticks, you start chasing price action. You came in with a bias where you were thinking market can't go higher anymore, so you short and then you get trapped. Or you think I'm just going to buy long today, and then big red candle pulls back in and you were oversized and you stop yourself out. So this message is going to be to those of you guys who may be facing that problem where you feel anxiety off the open. You maybe are a newer trader. Maybe you are very excited to pass your prop firm evaluation, or you're very excited to take that first payout. Guys, sit back, relax, allow the market to digest, right? Now, sometimes off the open, is there fantastic moves that go 40, 50, 60, 70, 80 points? Of course. Is it going to be the end of the world if you miss that trade here and there? Of course not, right? Typically speaking, the first 2 to 3, 4 hours of the market is generally the best time to trade. That doesn't mean that you need to trade the first 2, 3, 4 minutes of the market open. Me personally, I do like to see at least a few candlesticks kind of go by, okay? So whether that be 2 or 3 5-minute candles, whether that be the first 30 minutes. But if you notice on my screen here, I've drawn this box, this little red box. This is the market open until the first hour candle closes. So essentially, this is the first 30-minute range. Notice how we get a push down, we get a little bit of a push up, starts to break the 20 SMA, gets rejected, comes all the way back down to the bottom of the range before finally trapping shorts and putting on a fantastic move. How many of you guys are sitting there playing the 1 minute time frame, the 30-second time frame, the 2-minute time frame, getting in and out of trades, getting stopped out? Unless you're a very, very good scalper where you understand your risk and you understand that I'm going to get in and I'm going to take 3, 4, 5 points, I'm going to get out and I'm going to repeat the process. Again, we're trading the NASDAQ 100. We realistically don't need to treat this as the SPY, right? We don't need to treat this as ES where, a 3, 4, 5, 6, 10 point move is a fantastic move. The NASDAQ is another beast, right? We can pick up essentially 20, 30, 40, 50 points, not ticks, points, off some of these moves if you are sized correctly. Now, if you're in, 5, 10 mini contracts, you're going to get destroyed when this thing pulls back 10, 15 points. But if you're sized smaller, so you can withstand some of the ups and downs, then potentially you can catch some of these larger moves that tend to get put in. Now, if you notice the price action after the red box, we kind of build this floor, we close back over the 20 SMA, you get a little bit of a confirmation that for some people could be a hit or miss, right? And I say that because there's traders out there who are going to put a hard stop loss under the 1 bar and it's going to wick you out and then go right in your favor once again. For me personally, with price action like this, what I tend to do is I look at the whole situation, okay? So even though, yes, this is a setup here, yes, I understand that my 1 bar stop should be here, I'm going to wait for this candle to close, okay? I need this candle to close below my 1 bar stop. Now, does that mean, that I'm not going to take a bigger loss if it comes all the way back down here? Of course not. But what I'm going to tell myself is if we put in a low here, and we put in a low here, and then here, well, this looks like it's starting to form a little bit of a floor. So if price action was to close below that, I want no part of the long position. Does that make sense? So what I'm going to do is personally size down on my contracts, 1, 2, 3 micro contracts, 1, 2, 3 micro contracts, to allow myself to sit in this move even through drawdown as long as we're holding these bottom wicks. Now, if that's the case and you got into this and yes, you took a little bit of heat, a little bit of drawdown, Once this does start to pop back up and close over the 20 SMA, kind of trickles around for another 15-20 minutes, and then this thing really starts to go, right? It really starts to go and holds this 20 SMA all day. You can see multiple back tests of this 20 SMA. So this is a back test here, this is a back test here, this is a back test here, and a back test here. Now, again, I'm not saying that anyone is going to ever catch the whole move because, again, you know, human emotions come into play and we're all human beings, you know, that I know of, right? So again, if you're just looking at the situation, you know, am I going to say that, hey guys, everyone should have been in at the price of 17,216 and you guys are still in at, you know, what is this, 17,462? I mean, this is a 200-point move. Maybe, right? Maybe. But, you know, majority of you guys are going to take profits off at 40 points or at 50 points or hell, 100 points. But what I want to show you guys is that if you can control your emotions, there was no reason to get out of this trade. Now, for all of you concrete thinkers out there and you smartasses, someone's going to say, well, it wicked below the 1 bar stop. Wouldn't this have stopped me out? Maybe, if you're going to not give it the low. Well, I want to make an argument, right? I want to make an argument because a lot of you traders are looking for a system where you can just plug and play and, you know, not do anything. Meaning if something happens, I can just click buy and I don't have to do anything until I take profits. That's not the case. This is trading, guys. If you can't watch the screens, you need to work, you got to do something, you know, for the family, you got to run to the store and you can't watch the trade and manage it. Sure, I understand that. If you want to protect your risk a little bit more, I understand that. But why don't you just tell yourself this? Because it's so blatantly obvious. I mean, blatantly obvious that if we were to lose these 3 bottom wicks here, that this price action can go lower. Instead of trying to take your normal size of 5 micros or 1 mini contract, why don't you just take 1 micro? Why don't you just take 2 micros? Even if this does stop you out, what is it going to kick you out, right? Let's look at the actual amount of damage that you would have taken. So if you were to get in here at the highs of 17,216 on the confirmation, right? The next candle, right? The next candle is what you're getting in on. We close over the 20 SMA. You're getting in on the next candle that takes out the high. So if the high price that we're getting in at is 17,216 and you gave it the bottom floor here of 17,166. Okay, so let's just do the math because this is going to be a big stop loss for some of you. But if you look at it from 16 to 66, we're talking about 40, 50 some points, right? 50 some points. So you can do the math as follows. For every 1 contract, again, it's around 50 points, 50 to 60 points. So if you're thinking, well, that's too much, you know, I can't give myself that much risk. The reason why you can't give yourself that much risk or you think it's too big of a stop loss is because you're playing with too much size. Sure, if you're playing 5 contracts, if you're playing 1 mini contract, taking a 50, 60 point stop loss hit is going to be detrimental. But if we play 1, well, I'm not going to make that much. Says who? Says who? You know, says you? Well, then that's just your own opinion, right? Because my opinion is telling me I'd rather be able to be a part of the party. I'd rather be able to show up to the dinner table and eat than to miss out at all because I want to keep, you know, I want to be a stiffler and I want to keep such a tight stop. The problem with a lot of retail traders is their stop loss is way too tight, right? Way too tight. Like we need to have a stop loss. That's 100% a fact, but it can't be super tight, right? You need, especially on the NASDAQ, you need to allow this thing to work. And the way you can get around that is by sizing down. And if you normally play, let's say 6 micro contracts, play 3. If you normally play 2 micro contracts, play 1. If you normally play 10, play 5, right? Because if you take a 50 to 60 point stop loss, you're essentially going to lose, let's call it $100 a contract. So if you're in for 2, you're going to lose $200. If you're in for 3, you're going to lose $300. Great. I think that $200, $300 loss per trade is okay. That's manageable, right? If we happen to lose that trade, maybe we don't take any more trades for today and we come back tomorrow. But if you play 3 contracts and essentially you hit at a 1-to-1, you gain 50 points, 60 points, you're going to make $200 or $300. And if you hold a runner, I'm a big advocate of, if we're going to give up 50 or 60 points, let's take profits at 40, 50, 60 points. Let's leave a runner, move stop loss to break even, or just shy of break even. We kind of just trail it up a little bit. However you want to manage your trade is up to you. There's no right or wrong way to manage a runner, but hell, you could just leave your stop loss as a 1 bar, right? So if you're going to get in here over the candle at 7:15 a.m. Pacific Standard Time, you can just put your stop loss underneath that candle, just move it up from here, right? So if our original stop loss is going to be down here, we could just move our stop loss up here. That way we kind of mitigate our risk a little bit. And then as price action starts to go and it starts to move higher, then we can move our stop loss to like break even. And then as it starts to move higher again, we can put our stop loss at the next swing high. And as the market continues to higher, we can move our stop loss up to the next swing high, and then the next swing high, and then eventually you're going to get stopped out. That's one way to manage your trades. But again, if you are going to complain because, well, if I would have got into this trade, I would have gotten stopped out. But you have to have some level of common sense, because even though it does trigger below, right? I feel like this is like the 100th time that I've said it, but I still feel like people don't understand it. When I get into these trades, my stop loss is a close below my 1 bar stop. Okay. It has to close. I don't give a shit about a wick, right? Because look at what happens in this particular situation. You get a wick and then you get a bounce back, and you could have essentially made money. And I don't want to hear that, well, what if it goes all the way down here and closes? Well, then that's my problem, right? Then I'm going to have to deal with that, because my stop loss needs to be down here, right? It needs to be down here for me to want to get shaken out. Like we start closing below that, that's when I'm going to have a little bit of panic, a little bit of fear. So again, how do you get around that? What's the workaround? Size down. And I don't want to hear the argument of, well, I'm not going to make that much money. I'm not going to make that much money. It's not about the dollar amount that's on your screen. It's about analyzing the charts, reading price action correctly. It's about making good trades. It's about allowing yourself to manage your risk accordingly, like an adult. I don't want to hear people say they took a loss, they got chopped up. You got chopped up because your stop loss is too tight. There's only one real move in the day. It's going to go long or it's going to go short. The other move is that it's a sideways market, meaning that we are finishing on an inside bar day. An inside bar day means that we never took out the highs from the previous day or the lows from the previous day. That's an inside bar day. You need to get really good at identifying inside bar days and either stay away or trade the range. But again, this was not an inside bar day. We clearly broke the previous day high on this chart, and we clearly went higher. You should have been taking part in this move. Now, again, there's other setups as you get in more advanced. I teach other setups and evolution traders. We're looking for setups all day long. So if you did happen to miss the initial move, it's not like there wasn't another move. I mean, you can see here we get this new high and a pullback into the rising 20-day moving average. As soon as green candle takes out red, you can go ahead and get long again. You have a 1 bar stop system. There's another trade there. You could have also taken a previous hour candle high, right? So if you notice the high at 8 a.m. here, this is the high at 8 a.m. You would take this breakout here, pulls back into the 20-period moving average. The 20-day moving average is your stop loss, and then you would have to sit through this. You can also go through with the next hour high, which was here. Whoops, let me draw a tighter line here. The 9 a.m. hour high was here, so you would essentially been getting long. In this particular situation, you would use a previous swing low as a stop, and then you would essentially ride that up. Again, these are all just different entries. These are all just different ways to manage risk. At the end of the day, you're a risk manager. You're not a super cool day trader. Nobody gives a shit what you're doing all day. You're not saving the world. What you're doing is managing risk. You want to play this game. You want to be in this industry. You want to be in this business. You need to make sure that you're managing risk. It's not just about the strategy. I can sit here for 5 hours and give you a million different strategies that all are going to work. Some of them work a little bit better than others. Some of them you know, maybe hit at 60%, some of them hit at 50%, some of them hit at 70%, some of them hit at 40%. Again, your win rate percentage has to do with the number of trades that you take, stopping out on the day. Even if you're hitting at, let's say, a 55% win rate, some people are going to sit there and think, well, if 55% of my trades win, how am I ever going to be extremely profitable? Because some days you're going to have a market environment, market conditions where you take 3 or 4 trades and you're going to win every single one of them. So you're going to finish with 100% win rate on the day. Tomorrow might be 60% win rate on the day. What we need to do is manage our risk, and we need to manage, you know, our gains in a fashion where take your living expenses. If you need $7,000-8,000 to live per month, and you can start making $3,000 to $4,000 a month added extra income, that's really good money. You can then work your way into making $7,000, $8,000, $10,000 a month, but you need to walk before you start sprinting. You need to crawl before you start walking. Okay, does this make sense? So you have to start somewhere. If you guys would like to get involved in the room at Evolution Traders, definitely join me. I would love to see you guys in there. I'll catch all of you guys on the inside. To those of you guys who are on YouTube, I'll see all of you guys on the next video. Make sure to like, comment, and subscribe, and I'll catch you guys all next time.